Aloha market scholars, glad to be with everybody here today after a week off in sunny Hawaii. We really appreciate coming back to Utah where it's been raining and cloudy ever since we've gotten back and 40 degrees. It's been kind of nice to be able to get to a place where it was actually pretty sunny every single day. Same temperature every single day. So we had a good time. Glad to be with you. So today's video is a relatively longer one too, just like my last one was, just because there's a lot to talk about with what's happened in the past week, week plus. So bear with me on that. On today's video, we cover a lot of ground today. As bullish as we were before I left, and it's typically as when I leave, there tends to be volatility. That actually only showed up in small caps. Very, very big divergence in performance the last week or so between those large cap tech stocks and small caps, which previously had been so bullish. So I'm going to break that down. We'll take a look at a stock which had earnings here recently, and we'll talk about how to trade that with our trade idea for today. So let's go ahead and get started. Today is Wednesday, April the 14th, 2021. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator. And you can see right off the bat, one thing that really stands out to me for the first, again, looking at this for the first time after being gone for more than a week, is just how high the S&P has gotten above its 30-day moving average, right? Again, we haven't had an intermediate pullback here. Like, we've had periods of volatility with light pink shading and yellow lines, but all of those light pink shading and yellow lines produce buying opportunities, produce dips that were bought up that never did produce an quote-unquote intermediate pullback. And now you can see the gap just continues to increase between the 0 and 23% level, and we are obviously well up above that. In fact, we are so far up above the 23% line that the 30-day moving average is barely itself inside the 23% line. That's how far up we move so fast. And you look down here at the bottom and you say, okay, where we're at right now relative to where we've been in the past, obviously we're only in the 81st percentile because all the other periods that we've been higher than the current level was coming off of the COVID low point when we were so strongly above the 30-day moving average. All the other times, you can see right there, we got further above the 30-day moving average. You can see what happened. And over here, we got above the 30-day moving average. And that kind of started this period of up and down volatility that showed more weakness in the NASDAQ and then the Russell than it did in the S&P. As you can see, if you look at, again, this started right here in, what was this? December. That's where we really got sold with that overbought cluster in December there. Well, if you look at, here, let me just make that. If you look at the NDX, you can see that we started, December here is right there. It still went up a little bit further, but you can see it started its pullback eventually. And then, of course, the Russell also started its pullback a little bit later eventually. And so that just never did happen, as you can see here on the SPX. But if you go back, the last 10 years outside of that COVID low, you can see there's not very many other times that we've gotten, on nearly 5%. This is what, I think this line is at just a little over 4.5%. That appears to be kind of a limit as termed. Now, it doesn't mean that we have to drop. It just means that that's the strong momentum. It's hard for us to extend further away from the 30-day moving average without us slowing down. And you can see that slowing down manifests itself here with the MACD that starts to roll over, right? So that strong momentum that pushes the MACD up to a peak, and you can see other peaks here, that's what pushes up so far above the 30-day, and then we just the MACD starts to roll over. We can still go up. It just won't go up with the same momentum because the MACD is not going up anymore. And that's just not on the histogram itself, but look at the MACD itself. The MACD itself, this blue line, how high it is. Now, granted, that line is that MACD line there. It is high because the price is high. So if I were to look at a relative MACD, which is what this PPO is, but then now look at it on an 8 and 17-day basis, exponential moving averages, and then let's get rid of that MACD right there, then you can see it's not nearly as high. It's not as as crazy high as what the MACD itself is. You can see it's actually lower than some of these peaks, but still relatively high. I mean, you'll see where my cursor is, and again, this is 1.3%. Look all across the left, and you can see even that daily MACD between the 8 and 17 day moving averages is in the 88th percentile of the last 10 years. And that's about as high as it gets. All right, the peak here looks like 1.33, 1 1/3. So if I were to draw that line, whoops, here, let's edit that. I don't know why. I didn't think I set that to default, but let's set that there. And it's actually, sorry about that. Let's edit that again, and we'll extend it to the left and set it at 1.33. There it is. So there's our level, and again, there's your post-COVID coming off the COVID low points. But every other period, you can see, this is about as high as we get. There's another peak coming off the 2011 low point that got pretty strong, further up above where we're at right now. So, needless to say, the S&P has had some very, very strong momentum over this past week. And the question now is not whether it will stay up, because when you have strong momentum, it's hard to go down. The question is whether it will maintain this momentum, or whether we will slow down. You can see this is actually a bullish intermediate confirmation signal. Strong bullish posture, about as strong as an intermediate posture as you can possibly get. Market sentiment, you can see, is crossed back above 80 again. But you notice the momentum lines dropped down, not to an extreme low, but it dropped to an oversold level. When combined with a strong bullish posture, that's a bullish signal. Now, keep in mind that the near-term line did not drop below 52, and 50 as well. And you can see that we are now 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days with the near-term line up on this current run. It's on a typical 7 to 12 day run. So that's a pretty decently long run there, that we want to keep in mind. That you wonder how much longer a run like that can sustain itself. So these intermediate confirmation signals are great earlier in a run. There was one, this was one that led to a little bit of a jump higher on the momentum line. This was one that led to a jump higher. Now the question is whether this one will lead to another 4 or 5 day run higher, which would get us to about a 20-day near-term rally, again on a typical 7 to 12 day run. On the Russell 2000, you can see the NASDAQ looks a lot more bearish. Still the same pattern, bullish intermediate confirmation signal with a very long near-term rally too, about the same time frame. The Russell 2000 looks a little different. It's trying to figure out this trying to get something going. It's still very flat in between the 0 and 23% level, and all the lines are sitting below the 60th percentile. The near-term line sitting below the 60th percentile too. Remember, the 60th, getting above the 60 is when you're bullish. Between 60 and 40 is neutral, and getting below 40 is bearish. So we maintain about as neutral as you could possibly be on the small cap index, whereas the NASDAQ and the S&P about as strongly bullish as you can possibly be on the intermediate basis. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, that you liked your video today. And number two, that you want us to do another video again tomorrow. Quick way to give us feedback if you like our videos. If you don't like our videos, of course, you don't have to click on anything. But if you do and you want to let us know, you can do it really easily with one click. You can do it right now even. While you're watching the video here. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. You get access to our Market Outlook community, or our Market Outlook forum in our community, so you can be able to interact with other market scholars that watch these videos as well. Follow me on Twitter for more content in between the videos from day to day. There's my handle right here at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, make sure you check out some of these other things over here on the right, including our Market Outlook live video. So every day I do the Market Outlook. I also do a live video at 3:30 Eastern Time. It's a trade review video, so all the trades that we do in these Market Outlooks at the end I actually put the trades on before the market closes. So if you want to catch those trades on the day that we make them instead of the day after when you watch these videos, then you can get that with these videos. We also take a look at all the trades we're still in from other videos, from past videos, and talk about when we get out of them. So make sure you check that out there. You get access, all of our paid subscribers, our monthly and our premium subscribers, all of them get access to that, as well as all of our paid subscribers also get access to all of our trading rooms. Now our premium subscribers get access to our Q&A sessions, as well as our premium tools and access to our communities for all of our classes. So there's a lot of other things our premium subscribers get too. But keep in mind that while it is a 3-year subscription, it is actually the monthly. When you average it out monthly, it's actually less money than our month-to-month limited access. So keep that in mind. That's why most of our subscribers are premium subscribers. Come down here to the bottom, click on that heart. It opens up a new tab. Like that Market Outlook, today's Market Outlook tweet. Hit that like button right there. Same thing. Hit this thumbs up icon. Opens up another new tab. Hit that like button as well. Again, the more you do that, the more people will see our content that actually follow us because of how these algorithms work. The more engagements these have, the more people see it. So it really helps us out when you do that. And we appreciate those who do like our content. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you actually engage with. So we try to make it really easy for you to engage with us right here. All right, now let's take a look at the weekly chart, which is just looking so strong. Let me show you the S&P. Look at those strong bullish candles we're getting. And again, this is the intermediate rally that we've been on, right? Short little drops right there, but nothing significant. No red arrows, right? Which is what you typically get when you're on a intermediate pullback. You tend to get these red arrows on the 50-day moving average. We never did get that here, so we never did drop below the 50-day. Again, you notice on the NASDAQ we did, and then on the Russell 2000 we came really close. Again, we never really did get the intermediate pullback. We came very close, but you can see again at 16.5%, the PPO, the weekly PPO for the Russell is a lot higher than the NASDAQ and even the S&P is, with the S&P being, again, you look at how far up that weekly PPO is. Let me just bring this up here, and again, leave it at the 1040. Hit OK, and then go out. I'm going to go back out 20 years. This is one of the highest levels that we've seen on that weekly PPO in the last 20 years. Again, you try to look to see what level can be higher than where we're currently at. Now, keep in mind, why is it doing that? Here, I'm going to come back and save this as a default. So let's come here and we'll do 8.18. I'm going to save this as our default. And oops, now let's save it as default. There we go. So there's the level, and you say, okay, we're not at the 100th percentile. We're pretty darn close. So when has it been higher? There in early 2018 was one period that it's been higher than where we're at right now. There in 2011, we got close. There in 2009, at the end of 2009, we got pretty close. In December, we got pretty close. Here in where was March of 2009? There's March of 2009, and we that was by the end of December is when it got to its highest point, coming off of that significant low point there. And then now you look at coming off that 2003 low point, March 2003, we got really, really high at the end of that run, but again, not to this level. So, really the only time that we've been higher than this is 2018, early 2018, and that started a bear market, right? A fake bear market, one that FANG stocks kind of masked in the U.S., but in all the other asset classes, it was full-on bear market. Bonds were up and bonds rallied that whole time. Gold rallied that whole time. They peaked there with that COVID. But that's, international stocks, bottom out, small cap stocks. We're in a bear market that whole time. Everything but the NASDAQ 100, which kept the S&P from actually going into a bear market. And so here we are again, that high between the 10 and 40 200-day exponential moving average. So very, very, very strong moves. When you look at this chart again, in terms of how far up above the 200-day moving average we are for all these levels, you can see, we're all 20% for the NASDAQ, 38% for the Russell 2000, even though the Russell's been pretty flat, 12% for the diamonds, and 15. Well, actually, excuse me, this hasn't been updated here. Let me do a custom here. Let me do the 5-year, because I was going to say it shouldn't be so high for the Russell anymore. Let's go 10 years. There we go. So we are down off of that peak for the Russell, but you can see the S&P is not. So the S&P is about as high and the Dow is about as high, whereas the NASDAQ has come off of its pre-September peak, and then the small cap stocks come off its early February peak, away from this 200-day moving average. So they're grinding down towards the 200-day moving average, and that process hasn't started yet on the S&P, on the large cap index. Still very strong. So that's a very strong weekly chart here. You can see that's actually on the Dow Jones, sorry. Here, let's look at the SPX. We are at the highest level in 20 years on SPX. So that kind of gives you, and we have been above the 90th percentile for a very, very long time here. We were there for the NASDAQ, but we've come off, and we were there for the Russell. We're starting to come down, still above the 90th percentile, so that's how bullish and how parabolic we had gotten with the small cap index. We're just now coming down to 14.25%, which is still higher than the S&P at 8.5%, which is the highest that it's ever been. So very, very strong move. Needless to say, very, very strong moves in a lot of these indexes. We've looked at this chart before. We've talked about the strong MACD, how high it is for the S&P 500. The stochastics obviously very high too. So not only is the MACD itself high, but the its moving average is at above 4.25%. To kind of give you an idea, that's about how high it got over here. And then the momentum stalled, right? We didn't go down, but we started to converge because that was a pretty strong peak. And by the time we actually got to that level, the MACD histogram was rolling over. So we're really at here. We're probably about at this level. So we still had another little run left before we started to converge. So we might have a little run like this left before we converge. Though I think I think a move like this actually be less likely now, because we were just coming off of a low there, and we're not just an intermediate low. We're not just coming off of an intermediate low here on the S&P. To kind of give you an idea of what the RSI looks like and the CCI for the S&P, you can see we had been above 70. We just fell below 70 today, fell below 100, but hardly bearish, right? They were not bearish levels. The Russell 2000 is still stuck in the middle, and the NASDAQ 100, you can see, is kind of a little bit more bearish than the S&P, is closer to dropping below 6, but still up above 60, so still showing bullishness there. You look at the directional movement index, and this is the one that's kind of kept the S&P from really showing strength until this past week. This past week, the negative index is dive bomb below 15, and the positive index got all the way up above 35. Didn't get above 40, but it got all the way above 35. So very big gap, which has caused the ADX to get up above 20. We finally got some at least light green shading here. You can also see that in the Ichimoku cloud, well up above the cloud, and we're almost up to 5, and we are up above 80 on the trend noise balance. So, but again, you look at like the Russell 2000, and we haven't had a trend. We've been close to zero this entire time. We've been close to zero over here too. So I mean, there's literally no trend at all in the Russell, and the NASDAQ also had started an intermediate pullback here. It's close to being above 80, and still only at 4. So Bollinger Bands, we are now still in the upper quartile, though getting closer to not being in the upper quartile. IWM, as you saw, right smack dab in the middle, about as in the middle as you could possibly be. And then the Qs, we are just barely below the upper quartile. So not bearish, but also not strongly bullish anymore either. All right, now let's take a look at the intraday chart, and you can see again, I was showing this in class today in our trading room. Look at this 90-day chart. So there's because we moved up so far coming off of that gap higher on the 5th, we moved up so far so fast that there's not a lot of volume here. When you look at the comparison relative chart on IWM, you see we're still sitting around the point of control. We haven't gotten up here because it's been underperforming. Even the Qs have some volume in this area because from over here, remember we are well up above that on SPY. So right now, on a short-term basis, SPY has very poor margin of safety. That doesn't mean we have to fall down there. It just means that if there is some kind of catalyst to slow this momentum down, then there's nothing keeping it from getting down to 398 relatively quickly as we rallied up off it. In fact, you would expect it to actually come down faster than we rallied up. But again, literally very, very little volume, hence very poor margin of safety. That is not the case for a small cap index, and to a lesser degree, there's still little volume there. We could fall down to 325, but not it's not as bad, right, as it is on the S&P 500. So keep that in mind with what we're seeing here on the short-term chart, and that gap here. We're looking at the gap between the high and the low, which typically is that the rubber band stretches out to about a 5% mark between the two. Well, right now that rubber band is stretched to 7%, almost 8%. The high above the low point. That's a very strong. Stretch. Right, again, 5% is a limit to where you can stretch it out and it gets too stretched, and we're here at 7.5%. So it's one thing to be at 7.8% when you're coming off of a strong low point that you bounce off of really quickly, and you basically have a strong gap because you dropped so much and you've come back up to the top very quickly. And so a lot of times you get a strong stretch when you're close to a high point. In that case, because you're just filling in a big move that you created with a downside move. Well, we didn't create this with a downside move. We actually stretched the band out here, right? If I go out further, just to kind of give you some perspective, see the band was right here. We've stretched it out from this level all the way up. So we've created the stretch with a bullish move. And so again, keep that in mind in terms of the margin of safety. You've got this rubber band that's stretched out further than normal when you're on bullish moves, and you got very, very little volume here below where we're at right now. Not the best sustainable type move, right? When you look at today's volume and trading range, very, very small. The range was 3 points. No gap there, but 3 points. The trading, let's see, we didn't get the volume here. It's on this chart. The volume was at 61 million, so we've been well below the 100 mark. 3 points is down here. We're down to this 1% mark. So again, breaking the 1% mark creates a sustainable intermediate trend. The issue is we're already on a very mature intermediate trend that started here at the beginning of November. We are now 5.5 months along on a typical 1 to 3 month time frame. So very mature intermediate run that in the past we know that 1% mark can actually act as a support in that level. And when you look at the volatility here, it had a little bit of a rally here late, but still very, very low. As volatility here has gotten back down to extreme lows, down to the 80% mark, and down again. When you look at where we've been here, and just for some perspective, this 80% mark, the last time we were at the 80% mark, we were just below 20, and now we're at 16.5. So again, this is kind of telling us that volatility is a lot lower than than where we've been. As that VIX, what this is saying is VIX 3M is actually still holding up pretty well. They're up above 20. Right, so we're not really getting the same drop on that back month as we're getting a much bigger drop in the 30-day than we are in the 90-day. So very complacent market, in other words. And we see that as well in this chart here, where we see the 20-day average of the number of stocks that are above the 200-day moving average in the S&P. When you look at the current value, we are at very, very high level. Almost 94% of the S&P stocks are above their 200-day moving average. If I smooth that green line out with a 20-day average, then you can see the 20-day average has gotten above 90% for the first time in a very, very long time. So, extremely bullish. You see that the Shiller PE ratio has gotten above 37, which is a very high mark. That's been brought up. I tweeted out quite a few things about that, so check out my Twitter feed. Here's some things. I really like Med Faber. He does a lot of really good work on CAPE valuations. And again, you can kind of see, again, it doesn't, at 37 doesn't mean, oh, well, I guess we're going to drop tomorrow. No, it doesn't even mean we might drop in another year. It just means that, you go out 10 years and we're looking at very, very low returns. All that doesn't mean that we'll get 10 years of nothing. It means that within the next 10 years we'll get a real bear market where we get really struggling. We have 1 or 2 or 3 years of significant downsides that can throw off a 10-year returns. In the case of 98, 99, 2000, we had 2 downturns within the next 10 years that created a 10-year period of very little returns. You can see here. This period right there that he's referring to, if I show you this chart, the rate of change, sorry, it's right here. And then let's go back to let's go to 20 years. Let's actually go to 2000. Let's go to 1998. And then to now. And then let's change the rate of change to a 1-year rate of change to kind of give you an idea. In fact, let's actually do, let's do a 10-year rate of change. And let's go to 1988 on this. Let's see, it looks like it won't let me do that. All right, so let's just go to a 1-year. You know what, I'm going to do 10-year, but I'm going to come here and here, and we're going to look at a monthly chart. There's our 10-year returns. So there's those 10-year returns in 98, 99, 2000, but the CAPE ratio got very, very high, obviously. Those are the last 3 years, according to Med Faber, that we closed the year above 35 on CAPE, those 3 years. You can see the 10-year returns got to negative returns, got to 0 by the time we got to 2008. So 10 years after 98, we had one downturn and the beginnings of another downturn by the time we got there. And then by the time we got to early 2009, 10 years after March of 1999, right there, we had 0 returns. And again, as late as 2010, December 2010, which was 10 years after December of 2000, again, two downturns that created a 10-year period of 0 returns, right? After about a year and a half of negative 10-year returns. So, we're not as high there, right? We're at 200% for a 10-year return. That's not as high as we were in 98, 99, 2000. But on a CAPE valuation basis, we are as high now as we were in 98. So are we going to get another 2 years, year and a half of really good bullish moves? I think that's actually probably pretty likely. But as you saw even in 98, that doesn't mean that we don't get we don't get intermediate pullbacks during that time frame. All right, so to summarize the technical outlook, I mean, we're very strongly bullish. We are very strongly bullish on an intermediate basis. We're actually very maturely bullish on a near-term basis. That doesn't necessarily mean that we have to drop. It just, but you do have to take into account the very poor margin of safety we're seeing in the S&P. So the environment is set up for us to have, a pretty decent like exhale that we haven't had yet, but we haven't had this poor of a margin of safety either on the S&P throughout this 5 month long intermediate run until now. So this past couple of weeks, we've really kind of taken it up a notch in terms of how extreme we are in the bullishness. Then the question is whether that's sustainable or not. Obviously, anything can happen, but we don't want to be bearish when the market is strongly bullish. But it doesn't mean that we can't be aware and be ready for the type of move that this environment is very conducive for. So that if we fall, like again, that the gap between the 0 and 23% lines is nearly 5%. So are you ready for a 5% drop in the S&P, which would just be noise? I don't think a lot of people are, but and again, we can fall 5% and still not have an intermediate pullback. We could still be just on a near-term pullback because of the poor margin of safety. Are we okay with that? If you're okay with that, great. If you're not okay with that, if we're really one-sided on the bullish side, then we need to be ready for that type of move so it doesn't run us over, right? Because like I said, we can fall 5% on a near-term pullback and a noisy move and still be strongly bullish on an intermediate basis and still have a lot of people wailing and gnashing of teeth. And the environment is actually set up right now for that type of move because of the lack of volume and this speedy move we've had over the past couple of weeks. So I think something like that is very likely over the next week or two, and we just need to be okay with that. We don't have to like close all of our bearish trades and think, well, that's what we're going to get in, so let's be bearish. No, we still be bullish, but we need to be aware and be okay and be ready for that type of move. If we end up losing too much of what we've made over the last 5 months and that kind of noisy move, then that means we're a little too one-sided in our risk. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know what you're looking at that tells you why you're either a lot more bullish than I am or a lot more bearish than I am. All right, just kind of taking a look at what we've seen since I've been gone. This is the move that we had immediately at the day after I left. Was this? Let's see. Let me go. It's actually March 5th is my last day here, so it's March the 6th. So this is what's happened since I left. You can see the Qs had a really good run until today. The Qs have really pulled back today. Small cap stocks really struggled. Look at that big gap in performance while I was gone here between the Qs up 2.5% during that time frame and the small cap stocks down 2.5% in that time frame. Now they had a really good run late yesterday, and then today they had a good jump too, and then they fell back. And ended up with a loss along with emerging markets, a loss. Despite the dollar being very weak, emerging markets down despite the dollar being very weak. Commodity prices really, really taken off. So let's take a quick look at what that looks like here. Excuse me. We'll take a look at it on this chart. So let's look at the market forecast chart here, and we'll take a look at the dollar in context of the euro. And you can see how we've really kind of rallied back up here on the euro. So we had broken below that 78%, but it was just kind of a very temporary breakdown. We got a cluster, we bounced right back up, a little morning star candlestick pattern on April 1st. And then we got back up to the Fibonacci retracement zone. So we're still in this retracement mode, but we haven't, like, again, I'm not bullish on, even with dark green shading and a green line, I'm not really strongly bullish on or bearish on the dollar, which I will be. Long term, I'm very bearish on the dollar. But right now, not until we break that 23% line here, or at least break the 23% line on the long-term move, right? Which is, if you go out a little bit longer term here, this rally here, the orange line is the 23% line of that move. So, at least until we break that line, am I going to not be too strongly bullish or bearish on the dollar, bullish on the euro. As you can see, we're kind of sitting up against it now. We've hit it a few times before, so we're going to see if we end up holding some resistance here or if the dollar starts to rally a little bit off of that resistance. Because you always expect support and resistance to hold until it doesn't, right? Take a look at the same, what we saw with the commodities, right? Commodities, you can see, have really had a strong run too. a dark green shading and a green line. They never did get below the 23% line. They got down to it, and they've rallied back up to the top. And you can see the intermediate line is moving up higher. Market sentiment line hasn't dropped very much, so we really haven't gotten an intermediate pullback at all here. And so, how much longer, like after having a really good intermediate run, with about as noisy as a move as you could possibly get without it being an intermediate pullback, how much longer can we go up before we actually do get an actual real exhale? That's the question on commodity prices. And is this kind of one of those fake out type moves? You can see yields also haven't broken below their 23% line, so that's reflected in bond prices. They're trying to get going, but you can see kind of struggling here. You do have dark green shading finally, but you don't have a green line yet, and we're not even close to getting above the 23% level, which would signify the start of a pullback, right? Which would be a risk aversion environment rather than a risk appetite. Right now we're still in a risk appetite environment here, and you see that reflected also in gold prices. Again, it's kind of flirting with its 23% line, which is right there, sitting on that 38% line of a wider move, right? If I go out a little bit longer, there's that line right there. So the 38% line, we've fallen back down to that level. Now you can see on this little pullback move, on this current bearish intermediate rally, we're sitting right at that 23% line, unable to really get going, but it's trying, right? So again, getting above that 23% line and staying is a risk aversion environment, whereas staying down below it would be a risk appetite environment. So you can see the inklings of risk aversion out there, just not really like total risk off moves quite yet. And you see what's really driving a lot of this disparity between large caps and small caps is the move higher in XLK and XLY. Look at that strong trend higher, 3.5%, 3%, versus energy, which has been representative of the weakness in small caps, down 2.5% until today. And look at that big jump higher today in energy stocks before pulling back down here by the end of the day. And with utilities really strong throughout this run, right? Staying, lagging behind the market for the most part until catching up here in the last couple of days. This last Tuesday, if I just look at the last 2 days here, you can see energy outperforming the broader market. Energy and as well as utilities, outperforming the broader market, and financials, materials also outperforming. And there's your three areas. And you can see that also here. I've been showing you this chart. This, where is it? It would be, is it this chart here? Yeah, so come over here and you can see, here, let me make sure I've got updated to the end of the day. The risk off asset classes moving down to the left. So there's utilities, real estate, and staples moving down to the left, but so are financials, materials, industrials, and energy have been really moving down to the left. XLK, XLY, XLC have been moving up to the right, those two in particular in the leading category. So now, if these move down, which is going to move up to the right first? Will it be these safe haven areas that are still in the relative, still above 100? These two in particular are still above 100 on relative strength, or is it going to be these other cyclical areas, these small caps? They had a really good day today, but you can see how QQQ is really outperforming now small caps, and the trend has definitely changed. You have some strong momentum, so you might lose some of the momentum here, but the long-term PPO is rising now. The MACD is still positive there. We've really, despite any weakness we might get in the short term, you can kind of see that strong move on the Qs has really kind of coming off of that peak, that parabolic peak in the small caps, really sparked that run. Now the question is, will we be able to maintain a good bullish trend here and bullish and mature bullish intermediate trends on these indexes without a significant exhale? That's going to be that big question. And you can see from a sector standpoint, when you look at it on the 12 grid chart here, You look at all these charts. I mean, look at small utilities, staples, and real estate. They're very bullish right now. But look at XLK, look at XLY, and to a smaller degree XLC. They're also very bullish too. Some engulfing patterns showing up, but very bullish too. And we're starting to converge after being very bullish on these cyclical areas. Now they're starting to converge. Energy, in fact, is below its moving average with a very, very weak intermediate posture. So we'll see if these, the bearish patterns on these charts start to succumb. Right, these sectors start to succumb to that strong bullishness, and we get a return to the mean, so to speak, and maintain the strength that these bullish clusters, these early bullish clusters, offer for these safe haven areas. All right, so for our trade idea of the day, I wanted to look at one of those financial stocks that just released earnings, Goldman Sachs. You can see it itself has been on a very sideways trend. Nice little breakout today, but coming well off of the highs late in the day. So not really able, I mean, it looked like it was really strongly bullish, but not able to maintain the bullishness. As you can see, it's going to be hard to maintain some significant bullishness. It's going to be hard to have significant bearishness too, because the type of market we're in, but it's going to be hard to maintain significant bullishness to the upside because of how bullish it already is, right? And you can see the MACD is flirting with zero, the stochastics is moving up, but we had broken up above the 23% level early in the day, but ended up finishing down below it. And both the 8 and 17 days are still below the 30-day moving average. The DMI is showing, a breakout type pattern here, but coming off of what was already a strong bullish run, it's going to be hard to initiate a new strong bullish run. And you can see it here on the RSI and the CCI too. We're still in between 60 and 40. A nice little move to the upside, but kind of a neutral to bullish stance sets us up really nicely for, doing, especially coming off of an earnings here, sets us up nicely for an iron condor, to where we can say, okay, well, if it's going to maintain, a trendless type move, being strongly bullish, let's see, that's SPY here. Being very trendless, if we maintain a trendless move with the Bollinger Bands coming down to low levels and potentially staying down at low levels, then we can trade the sideways action with an iron condor trade. So if I look at here at GS and I come over here and I sell the 20 deltas, so sell the 315, sell the 360, buy the $5 wide to protect. So buying the 310 and the 365, that sets us up for a normal position size because we're through earnings now, getting almost about $500 for about a 50% return on that risk, as long as we stay in this kind of sideways range. Which, if I look at it on a longer term basis here, you can see what it looks like here. So as long as we stay right around the point of control of the last 90 days and stay in this area, then and you can see we can even move up to the upside a little bit, because it gives us a chance to stay bullish. We can move up to the upside. We don't have very much risk within the 1 standard deviation move to the upside, and we'd actually still be okay. I'm actually more concerned about a downside move. If we do break below this 38% retracement level, then there's a really good chance that we could fall down to 270 very, very, very easily, because of the lack of volume that's down there. So that's something to keep in mind if we do start to flirt with this downside, of looking at a potential directional trade to the downside, because of the potential that we could get on that lack of volume. So again, from a margin of safety standpoint, that's kind of showing how these financial companies have moved up so far so fast. When you move up so far so fast, you leave yourself with poor margin of safety. Doesn't mean we have to go down. It just means that it can really easily go down a lot. So that's okay. We're right now, I don't expect that it will. That's why we're doing a sideways trade. But if it does, we need to be aware of when we might look at protecting that sideways trade with more of a directional trade to the downside that can give us some pretty good potential reward for very, very low risk. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Remember, all of our subscribers, our paid and our free subscribers, have access to that. So let's keep this conversation going in there with all what we talked about here today. As always, thank you for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, like us on Twitter and Facebook as well, and comment on our video on any of those channels or even on YouTube down below. And like I said, let's keep this conversation going. Thanks again for watching. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.